Imagine waking up tomorrow with an unexpected $100,000 in your bank account. What would you do with it? Stay tuned as we dive into the simple yet powerful strategy on how to invest $100,000. Number 1. Max out contributions to retirement accounts. Once you've tackled pesky high-interest debts and secured your emergency fund, it's time to turbocharge your retirement plans. With a cool $100,000 windfall at your disposal, you can make some serious moves. Start by leveraging tax-advantaged accounts like IRAs and 401ks to build a robust nest egg for your golden years. Begin by maxing out your contributions to your 401k. Why? Because if your employer matches your contributions, it's like receiving free money. Who doesn't love that? Then, shift gears and max out your IRA. In 2024, the contribution limit for IRAs has climbed to $7,000. And if you're over 50, you can tack on an extra grand annually. 401ks offer even higher contribution caps, with 2024 limits sitting at $23,000 for employee contributions alone and $69,000 when combined with employer contributions. Now, that's a hefty boost. Plus, if you're 50 or older, you can kick in an additional $7,500 per year as a catch-up contribution. Number 2. Invest in mutual funds, ETFs, and index funds. Consider exploring mutual funds, ETFs, and index funds as your gateway to navigating the investment landscape with a $100,000 windfall. These investment vehicles offer diverse baskets of assets, sparing you from the complexity of hand-picking individual stocks. Mutual funds boast professional managers who meticulously curate their holdings, making daily trading decisions on your behalf. While they provide hands-on management, this expertise often comes with higher costs. ETFs, on the other hand, mirror indices like the robust S&P 500. Traded throughout the day like stocks, ETFs offer flexibility with trading orders and span various asset classes from conventional stocks to exotic commodities. Their real-time price movements add a dynamic edge to your investment journey. Index funds offer a more passive approach, diligently mirroring market indices without the fuss of individual stock selection. Historically, these funds have shown commendable performance, consistently outshining actively managed counterparts. Their simplicity and cost-effectiveness make them an appealing choice for savvy investors seeking reliable returns. By leveraging these investment vehicles, you can craft a strategic portfolio that aligns with your financial goals, backed by the reliability of proven market indices and the dynamism of ETF trading. This approach not only diversifies your investments, but also amplifies your potential for long-term financial growth. Number 3. Buy dividend stocks. Investing in dividend stocks offers a tantalizing opportunity to grow your wealth. By owning these stocks, you unlock 2 paths to potential prosperity. Firstly, you can receive cold, hard cash in the form of dividends, providing an immediate income stream. Secondly, you have the option to reinvest those dividends, compounding your investment by acquiring more shares over time. This not only enhances your ownership stake, but also sets the stage for larger future dividends and long-term financial gains. While it may seem alluring to chase after stocks with the highest dividend yields, it's crucial to tread carefully. High yields can often be a red flag, signaling underlying issues within the company. Instead, the savvy investor knows to seek out companies with a track record of steadily increasing their dividends. These are the true gems of the investment world, like the legendary Dividend Kings. These elite stocks boast an impressive legacy of raising dividends for a minimum of 50 consecutive years, showcasing resilience, stability, and a commitment to shareholder value. Number 4. Buy bonds. Consider adding bonds to your investment strategy. It's like adding a sturdy pillar to your financial fortress. Bonds not only diversify your portfolio, but also balance the highs and lows of stocks, making your investments more resilient. Imagine receiving regular payments, like a steady drumbeat of income, through bond coupons. The safest bets are government bonds, backed by the unwavering support of the U.S. government. A beacon of stability in uncertain times. If tax efficiency is your game, municipal bonds offer earnings exempt from federal taxes. For simplicity and broad exposure, consider bond ETFs or mutual funds. offering a straightforward path to a diversified bond portfolio. Number 5. Consider alternative investments. Exploring beyond the typical avenues of stocks, bonds, and cash opens up a realm of exciting possibilities in the investment world. Imagine venturing into alternative investments. These are the renegades of the financial landscape. Picture yourself delving into the mysterious allure of precious metals, the futuristic realm of cryptocurrencies, the solid ground of real estate, or even the rarefied air of fine art collectibles. These alternative investments aren't for the faint of heart. They're a thrilling roller coaster ride compared to the steady cruise of traditional investments. They come with a unique blend of complexity and risk, promising both the potential for higher returns and the chance to diversify your portfolio beyond the ordinary. Number 6. Invest in real estate. Imagine stepping into the world of property ownership, where every brick and beam holds the promise of profit. You have choices aplenty. Become a silent partner in a real estate investment trust REIT, where skyscrapers and apartment blocks work tirelessly to boost your wealth. Or, if you prefer a hands-on approach without the landlord woes, dip your toe into real estate crowdfunding. For those who prefer teamwork, consider real estate crowdfunding, a dynamic approach that lets you join forces with fellow investors to collectively purchase properties. This collaborative venture not only spreads risk, but also multiplies the thrill of profit sharing among like-minded enthusiasts. Here, your investment joins forces with others, forming a powerhouse that acquires properties and splits the spoils. Number 7. Fund a Health Savings Account (HSA). An HSA lets you stash away pre-tax dollars earmarked for medical expenses, from prescriptions to checkups, effectively reducing your healthcare expenditures. The beauty lies in its tax-deductible contributions and the potential to grow your investment over time. Withdrawals are completely tax-free as long as they're used for qualified medical costs. Plus, any unused funds roll over year after year. Once you hit 65, the HSA transforms into a versatile tool. You can use it for anything, although taxes apply if it's not health-related. HSAs are exclusively linked with high-deductible health insurance plans. It's crucial to verify if your policy permits opening and funding an HSA. In 2024, the contribution caps are set at $4,150 for individual coverage and $8,300 for families, marking an increase from the previous year. And if you're 55 or older, there's an additional $1,000 allowance annually as a catch-up contribution. Number 8. Park your cash in an interest-bearing savings account. Consider securing your windfall wisely by parking it in an interest-bearing savings vehicle like a certificate of deposit (CD). These financial instruments not only provide a safe haven for your funds, but also guarantee returns with interest rates soaring to new heights. Picture locking in an impressive 5.3% APY for a period ranging from 3 to 60 months. It's like setting sail on a journey where your investment is safeguarded by FDIC or NCUA insurance, protecting up to $250,000 per depositor, per institution. For those seeking a bit more flexibility without compromising on returns, money market accounts offer an attractive alternative. Take, for instance, the Quantic Money Market Account, boasting a competitive 5% APY on balances starting from zero. Accessible through ATMs, debit cards, checks, or transfers, it's designed to keep your money accessible while maximizing growth potential. Number 9. Consult with a financial advisor. Making decisions on how to best allocate this sum can be daunting without the time or expertise to explore all options. A skilled advisor can craft a tailored financial roadmap that aligns with your goals, whether it's securing your retirement or achieving specific milestones. These professionals bring a wealth of knowledge, offering insights into retirement planning, tax strategies, and investment opportunities that maximize your returns. By partnering with a financial advisor, you not only gain strategic direction, but also ensure your financial decisions are well-informed and align with your long-term interests. Choosing the right advisor involves evaluating credentials, understanding fee structures, and ensuring they operate as fiduciaries, a crucial factor in ensuring they prioritize your financial well-being. Seeking referrals from trusted sources, such as friends, family, or colleagues, can lead you to advisors who have proven their worth. Financial advisors typically charge fees based on a percentage. If you found this video helpful, don't forget to like and subscribe for more insightful content on personal finance and investment strategies. Leave us a comment below on how you plan to invest your next windfall.